I would like to extend a special welcome to our governor and deputy governors who are joining the event. My name is Lyle Horsley, and I head up the FinTech unit in the SARB. I'm also a member of the Intergovernmental FinTech Working Group, or IFWG, as it is more commonly known. Today is a very exciting day for us. Many discussions, long hours, and lots of planning sessions have gone into this launch event. The response rate to the event has been very positive, and I think that's testimony to the extensive interest in innovation and fintech developments in South Africa. Today is about Project Khokha 2, which is a technical proof of concept that explored tokenization in financial markets. PK2 builds on the foundations laid in Project Khokha 1 by expanding on the application of distributed ledger technology and a central bank digital currency in the financial markets. These topics will be explored in more detail as part of the panel discussion that's coming up further down in our agenda. For now, I'm very pleased to call upon the governor who will be delivering this afternoon's keynote address. Governor, the virtual floor is yours.
Thank you very much, Lael, for the introduction. You've just confirmed that once you work for me, you will always work for me. No one gets to steal from me and keep the loot. Welcome back to the SAP, and good day, ladies and gentlemen. Welcome once again to this virtual public release of Project Khokha 2 report. The project was launched in February 2021 as an initiative under the Innovation Accelerator of the Intergovernmental FinTech Working Group led by the South African Reserve Bank through its FinTech unit. PK2, as Project Khokha 2 is known, explored the implications of tokenization in financial markets through a proof of concept that issued, cleared, and settled sub-debentures using distributed ledger technology. In doing so, PK2 built on Project Khokha 1, which many of you are familiar with. Project Khokha 1 was our initial financial technology policy exploration and technical trial in the use of DLT for interbank settlements. It explored the use of distributed ledger technology for interbank settlements by successfully replicating some functions of the South African real-time gross settlement system on DLT. Innovation in financial services in general and in digital financial services in particular has made significant progress since the launch of Project Khokha 1 report in June 2018. One of the most noteworthy trends affecting financial markets over the last half century is what is referred to as dematerialization. Following advances in computer technology since the 1960s, financial markets started to move away from recording securities ownership in a physical ledger to recording ownership on centralized digital ledgers. Over time, this led to centralized financial market infrastructures such as central securities depositories and central counterparties evolving to play a critical role in recording the ownership of assets and, by extension, managing the risks involved in the process of recording the transfer and ownership of value. Building on this initial convergence towards the digitalization of financial markets, tokenization goes one step further by representing different forms of traditional assets, such as money and securities, as tokens on DLT-based platforms. Such DLT-based platforms move the recording of transfer and ownership of value from individual ledgers kept by centralized financial market infrastructures to shared distributed ledgers. DLT-based infrastructures may require fit-for-purpose money, which is appropriate for such DLT-based platforms. This has central banks opting to further explore the viability of tokenized central bank money in financial markets. Such exploration, although largely conceptual at this stage, is important given the growth in technological innovation and the use of new forms of payment instruments facilitated by rapid pace of innovation. In our experimentation during PK2, two forms of tokenized money were created to allow for settlement. The first form of money was a tokenized form of central bank money, which was a liability of the central bank issued into a specific DLT owned and operated by the sub in the proof of concept. This form of money was used to purchase sub debentures in the primary market. The second form of money was issued by commercial banks as a stable coin used by purchasing sub debentures in the secondary market. In this way, PK2 explored and expanded on how settlement in central bank money and commercial bank money can happen on a distributed ledger technology. The debentures token market benefited from having a riskless settlement asset in the form of a wholesale central bank digital currency used for settlement. This reduced the settlement risk, particularly that payment might fall or might be uncertain due to the settlement. The wholesale central bank digital currency prototype developed in PK2 was also the preferred asset in other instances. It served as the reserve asset, guaranteeing the value of the wholesale stablecoin issued by commercial banks. And it was used to make payment to debenture token holders over the maturity of the debenture. The role of the central bank in the tokenized debenture token market was therefore similar to the current role played by the central bank. Our attempts to learn more about the relevant technology has been guided by a few principles that can also be referred to as the 5 Ps of fintech policy exploration. And as I explore to unpack these elements in a little more detail, I need to underscore that as a central bank, we are technology agnostic. We embrace technology, but we are technology agnostic. The first principle that drove us had to do with the purpose-driven projects. From a central bank perspective, practical exploration should always be conducted with a purpose. Central banks should therefore play to learn and gain deeper insights into technology-based innovation and its potential impact on their mandate, as well as on any relevant policy and regulatory frameworks in the financial system. I refer to the term playing deliberately because our exploration with technology often happens in a controlled environment, whether it is a proof of concept such as Project Khokha, or whether it is a regulatory sandbox that in South Africa we would have called a regulatory sandpit in the event of live transactions on a confined basis. Since DLT-based innovation is still quite nascent, it is difficult to reach definitive conclusions on its potential implications. In this way, practical experimentation helps inform our thinking about different scenarios which may arise in the future. PK2 was an experimental research project. It followed an exploratory approach which enabled the proof of concept to contribute to the complex discussion surrounding tokenization in financial markets. PK2 does not signal support for any particular technology, nor does it signal any specific shift in policy direction. The project was not about replicating the status quo. Rather, it was about challenging our thinking around designing for a different future. The next P is playing in collaboration, which is a guiding principle for much of our work that has been following the African proverb which states, if you walk to go fast, go alone. But if you walk to go far, go together. The technical teams are continuing to explore how they can build different applications in addition to the ones built for the prototypes during the main phase of PK2. This is to ensure that we can get the maximum shared learning out of our collaboration. The PK2 report is the SAP's contribution to broader discussions surrounding the regulatory treatment of crypto assets and financial market innovation. We explore that, we hope that it provides meaningful insight to the discussions taking place between policymakers and regulators as they continue to consider the most appropriate way to amend the existing domestic legal and regulatory frameworks. We recognize that digital currency innovation cannot be explored in isolation. The South African Reserve Bank continues to draw on the insights emerging from various initiatives, including but not limited to our ongoing study into the feasibility, desirability, and appropriateness of a retail central bank digital currency. And this is meant to enrich our understanding of digital currency implications. It is also important to acknowledge the inherently borderless nature of distributed ledger technologies and the critical importance of international collaboration. The SAP was a proud participant in the Bank for International Settlements-led Project Denver, which considered how a multi-central bank digital currency platform could be used for international settlements. The Project Denver report was released 2 weeks ago, and I would like to strongly encourage you to read it, as it provides insightful supplementary views and information to the PK2 project. Such initiatives further emphasize the need to consider interoperability and integration between various digital currency and transfer of value platforms. Next is P is pondering the outcomes, which explores the implications of the DLT-driven innovation through practical exploration. Such exploration leads to practical insights which require further analysis, research, and dialogue. However, pondering on the lessons learned and the insights gained should not lead to analysis paralysis or unnecessary pontification. It is thus important to interrogate the efficiencies and benefits that new technology may introduce in the context of DLT-based platforms in financial markets. Potential efficiencies relate to, firstly, increased transparency in the holding of securities. Secondly, reduction in costs due to automation. And lastly, the removal of multiple manual reconciliation processes across a network of intermediaries. One of the primary risks stems from the lack of regulatory certainty, as the existing legal and regulatory frameworks for financial markets were not designed for trading, clearing, or settling on distributed ledger technology. The next P, of course, has to do with promoting responsible innovation, which looks at how innovation should be done in a way that the financial system is taken forward to benefit society as a whole. This includes contributing to achieving the objectives such as improving efficiency, lowering barriers to entry for financial activity, and addressing any challenges restricting access to meaningful financial services. And finally, policy and regulatory implications. The insights gained through practical exploration should lead to greater regulatory clarity, both for innovators and for regulators, and should be in the broader interest of ensuring a level playing field for all market participants. As financial services regulators in South Africa, we follow an activity-based and technology-neutral approach, although we are not technology blind. It may well be that innovation enabled by DLT may change the risks involved in a particular business process, for instance, reducing or even eliminating counterparty risks, which may in turn require us to consider the appropriateness of specific regulations. Regulators need to move with caution when considering developments before they implement any regulatory changes. As regulators, we should be fully appreciative that regulated entities require clarity before fully committing to entering DLT-based markets. Maybe as I draw my remarks to a close, some may ask whether central banks and regulators would still be relevant in a world based on some of the decentralized principles explored in Project Khokha. From a regulatory perspective, I think it is unlikely that decentralized markets will be suitable in all instances, or that decentralization will guarantee the achievements of public policy objectives such as consumer protection, financial stability, financial integrity, as well as safety and soundness, which fall within the mandates of central banks and regulators. The role of central banks, regulators, and policymakers should, however, evolve with financial markets to ensure that we continue to fulfill our mandates in future financial markets. Central banks, regulators, and policymakers can, and indeed must, play an active role in shaping a potential move to DLT-based markets through playing with purpose, playing in a collaborative way, pondering in the implications of innovations, promoting responsible innovation for public good, and informing an appropriate policy and regulatory response. Rest assured that as we launch Project Khokha 2 report, the South African Reserve Bank remains open to innovation. We continue to embrace technology, but we refuse to be locked into any particular technology. As I said, as a central bank, we are technology agnostic because we do not know where the winning technologies would come from. With those words, I commend Project Khokha 2 report for public release and for an engagement, and hopefully we would have a far more informed policy discourse that is actually informed by some hard evidence that had come from this report.
Thank you very much, Governor, for those insights and reflections. I think the 5 Ps that you've highlighted in your address provide the perfect blueprint for our continued work in the FinTech unit. Next up on the agenda is a brief video which provides an overview of Project Khokha and a demonstration of some of the technical work that was done and insights that were gained from the different participants on the team.
In August 2017, the South African Reserve Bank formally established the FinTech Unit to look at how FinTech innovation will impact the policy and regulatory environment. Through its work, the Khokha project came about in 2018. Khokha means pay in isiZulu, and the main goal of the project was to build a proof-of-concept wholesale payment system for interbank settlement using a tokenized South African Rand on Distributed Ledger Technology, DLT. The proof of concept was developed and service providers were brought on board to participate in it. In 2016, financial sector regulators in the country, the Financial Intelligence Center, Financial Sector Conduct Authority, FSCA, National Treasury, and the South African Reserve Bank, SARB, established the Intergovernmental FinTech Working Group, the IFWG, to understand the growing role of FinTech firms and to understand how the regulators can proactively assess the risks and opportunities of the rapidly growing digital financial services innovation. Project Khokha 1 kicked off its work and involved South African banks as well as technical and support partners. The project had a settlement of 70,000 processed payments within 2 hours of initiation. This was achieved in real time. Here is a brief demo of the Project Khokha platform.
Go into the Reserve Bank facility to tokenize funds for a bank, and we're first going to do the 10 million for Absa Bank. And you can see the transaction is confirmed. And after that is confirmed, it's received by the sender, it's submitted to the network, and it's been successfully processed. Okay, and Absa Bank obviously having the same view, where they have received and they have confirmation that they've got 10 million now. You can see the Standard Bank see that they have received the payment from Absa Bank with the same details. So payment received from Standard Bank, transaction 1 to the value of 1 million. Nedbank can also see that transaction. They can see that a payment has been made from Absa Bank to Standard Bank.
What you'll also see is the transaction volume picking up. So the transactions are now running through. You can see the transactions coming through on the screens. You can see the balances updating.
A transaction, and Standard Bank and Absa Bank had full visibility of that transaction for 2 million. And there's even some customer details, a company name, the account number that should be credited, so that Nedbank can now take that transaction and process it into the back office system and give credit.
We have now concluded Project Khokha 2, which, building on PK1, extends the proof of concept to financial markets. PK2 explores the tokenization of further assets, including securities, in the trade life cycle on the Distributed Ledger Technology, or DLT. The settlement of the transaction, which moved the security to the buyer and the money to the seller, happened on DLT through a dedicated delivery versus payment contract, which allowed for an atomic swap through a series of verification processes. Here is a brief demo of how PK2 functions.
The users being signed in. As this is the first load of the day, it does take a bit of time to fully load all of our data from both Samos and our node. You'll see that the user is able to, at the bottom of the screen, filter through the different transactions that exist both within Samos and the CDBC network. And in just a second, we'll scroll up to the top of the screen where we will request the issuance of CDBC, specify an amount to be issued, and in a couple of seconds, we'll see the notifications come through on the top right-hand side.
In this way, settlement of two linked obligations using a DVP settlement mechanism is achievable on the platform. As a central bank, we are exploring potential efficiencies, benefits, and risks of new technology, including increased transparency in the holding of securities, reduction in costs due to automation, and multiple reconciliation processes. However, these potential benefits also introduce possible risks, especially in the legal and regulatory framework for financial markets, which was not designed for trading, clearing, and settlement in a DLT-based environment. the SARB, together with other regulators, will continue its work in a manner that is appropriate and responsive.
Looking at the video, it's certainly interesting to reflect back on the journey that we had from Project Khokha 1 coming through into Project Khokha 2 and the many hours spent in preparing the project. I have a panel with me, which I will introduce shortly, not only with me, also globally around the world. And they've spent much of their time on the project. I will run through them very quickly, as I mentioned, and then also just to highlight that we are streaming on different channels. We are, however, mainly taking questions through the Q&A function on Zoom. And I note that Londui Buthelezi is quite aware of that, and he's even posted a question ahead of us opening up the floor. We'll do probably about 2 rounds of questions, prepared questions to the panel, and then we'll see how the discussion evolves from there. So looking at the panel very quickly, Lyle, who you saw speaking earlier, is my boss within the policy division, or the fintech division of the South African Reserve Bank. She was formerly a lead policy analyst within the Prudential Authority and a strong legal background as a lawyer. Going to Dr. Janette Blanche, she is the head of the division within the Prudential Authority looking at financial markets policy. Moving over to Toby. So Toby is in Cape Town, and you'll see his face on the screen. He's a co-founder of Block Markets Africa. We particularly wanted Block Markets Africa on the project as a fintech that is locally based but globally active. And so thinking about crypto and DLT and decentralization specifically. And then last but not least, as the saying goes, Dr. Osmin Mandeng is globally recognized as a senior advisor to Accenture, leading different initiatives, even globally, on digital currencies, involved in multiple CBDC projects. And so he has a wealth of experience. He's also been involved with different financial market structures, also with the International Monetary Fund, and he's obtained his PhD from the London School of Economics. As I move over to some of the questions, I need to get my technology to work with me. So let me just jump around over here to different device very quickly. So I'm going to go to Lyle first. And Lyle, so as the head of the fintech unit, the question often comes about, so why PK2? We've done PK1 in 2018. What is the link between the two, and what did we try to achieve with PK2?
Thanks so much, Gerard. So I think that in the governor's speech, he spoke about playing with purpose as one of the P's. And I think that's quite instructive, right? So when we do these kinds of projects, they must be based on informing a particular policy or regulatory question that we have. What we saw after PK1 was that there were emerging trends or activities that were coming through in the fintech space, things like tokenization, stable coins, decentralized finance. And so I think PK2 was conceptualized with those concepts in mind to provide more clarity to us as a central bank around what those things potentially mean. For me, PK1 and PK2 complement each other. PK1 looks at interbank settlement. It looks at how you could replicate some existing infrastructure in the form of the Rtgs on DLT. And so already there, I think we explored, how DLT could replicate some of the existing infrastructures that are regulated. And PK2 then goes one step further. So PK2 looks at, yes, distributed ledger technology in financial markets. It looks at a wholesale central bank digital currency in the financial markets, but it also goes beyond that. It looks at tokenization of a security. It looks at how settlement of that security could happen. Not only in central bank money, but also then in this new form of private money, which has come to be known as a stable coin. It looks at things like interoperability between platforms, and also then some decentralized finance principles as well. So I think all in all, both PK1 and PK2 provide some very useful insights to the central bank. Thanks, Gerard.
Thank you very much, Lau. So Dr. Blanche, over to you next. Janette, So what, particularly in your role as the co-chair or the chair of the IFWG, what benefit is there to industry and different regulators participating together on a project such as Project Khokha 2?
Thank you, Gerard. So from an IFWG perspective, it's really exciting. For us, a technical trial such as PK1 and PK2 creates a safe environment for us as regulators and industry to then learn and understand emerging innovations. So in this case, it would be the use of a distributed ledger technology in financial markets, wholesale CBDC or central bank digital currency, and wholesale tokens. So as the governor and Lal said, we like to play in this environment. So this is a complex topic, and it will hopefully assist us in formulating our fintech-related policy and regulatory frameworks in the future. And you will also note in the public report that the project team have highlighted some legal, regulatory, and policy concerns. So as regulators and policymakers, we will need to take these into consideration in our future work.
Thank you very much, Jeanette. So if I look at some of the design principles, when we developed this prototype, we gave the team some instructions. So what is it that they needed to develop? And I'll just go through a few of them very quickly. One of them is that we asked them to design or for DLT specifically. So build for the DLT world, don't replicate the existing world on DLT. We also noted that interoperability is quite important. So there's different of these tokenized forms of money and instruments, assets on DLT that's developing. So we need to explore interoperability. It's a key objectives for policymakers and regulators globally. We wanted the wholesale CBDC as a central bank instrument to be on a private permission DLT, so fit for purpose for that reason. The wholesale token, so the industry construct, we wanted the design to be more open. And then also lastly, for the platform that was used to issue the debentures, we wanted that to be close to an existing environment where there's multiple players involved. So the reason why I went through that, Toby, and I'm moving to you next. So as I mentioned in the introduction, one of the reasons why we wanted a fintech firm and a firm that's involved in DLT to be engaged on this project is to explore this designing or building for DLT. So Toby, over to you. How did you fulfill that role on the project?
Thanks, Gerard. I think for us, it was obviously a very exciting opportunity. And I think since 2018, when we decided to focus 100% around DLT-related financial services applications and how to build this environment, we had to unlearn the lessons that you've learned over the last 20 years in centralized finance applications. Because what we've seen is that financial markets around the world rely on this idea of centralization to protect and support all kinds of modern economic functions. And we've been doing that for 500 years, right? So the centralization, however, has increased the complexity as markets have advanced. And that's slowly but surely raising the barrier to entry and the cost of compliance for many players in that market space. So the interesting thing is decentralization is completely in its infancy, right? It's almost unknown what the implications of this would be. And it can challenge many of the tried and tested fundamentals that we hold dear in the centralized finance market. So when we explore the idea around decentralized financial market infrastructures and what they could look like, we had to be careful, as you said, that we don't just replicate the processes and mechanisms because that's the way it's been done for hundreds of years. We had to challenge ourselves and imagine what could it look like? What could DFMI look like to serve the market in new ways? And we took inspiration from the innovations in the decentralized finance space, obviously, and advice from leading innovators in that space, like South Africans, like Andre Cronje. And during the PK2 process, we wanted to draw attention to the practical benefits of tokenization in both the private and public markets. We found support from many of the industry participants, but also deep insights when trying to present this within this potential future regulatory context. And I can only say that it was definitely challenging. It was a process of unlearning for us, but that we found great support from the industry participants. So thank you for that.
Thank you very much, Toby. So my next question is to Azmin. Azmin, with your experience on these global CBDC projects, both wholesale and retail, but obviously our focus in this project is on wholesale CBDC. Can you maybe give us some insights in terms of what are the trends that you have observed on global wholesale CBDC projects, and what is the benefit for you of we often make this comment that we already have a wholesale CBDC in the sense that accounts with the central bank is already digital. But what's different? Why are we exploring DLT in comparison to what we already have?
Thank you very much, Gerard. Maybe I start with the second point. Many indeed do say that we already have CBDC, given the fact that reserves at the central bank are scriptural monies, so book entry monies. But I think that's not quite correct. The innovation with CBDC is the adoption of a new medium, a token, which has properties akin to a digital bearer instrument. That makes it quite different from what is an account-based money. So the idea with CBDC is therefore to go beyond the account and for central banks to consider offering not only as today physical tokens, banknotes and coins, scriptural monies, book entry monies like reserves, but then also a new medium, which is the token, to serve as native instrument on token-enabled financial market infrastructures. So therefore, I don't think it's correct to say that we already have CBDC. I think it is important to emphasize that the medium is the innovation. In terms of the recent trends, look, it's undoubtedly many central banks, as you know, are involved in a number of CBDC projects. Accenture itself has been involved in many. We concluded Project Jura with the central banks of France and Switzerland in December. Project Dunbar was announced by the governor earlier. We participated in, of course, Khokha 2. The e-krona, the project with the Central Bank of Sweden, issued a follow-up report today. Accenture has also been very closely involved. So there's a lot is, of course, going on. But in terms of new trend, I think there is a recognition that CBDC is becoming increasingly part of a broader ambition of equipping financial systems with needed capabilities to meet future payment demands, to remain competitive, and for central bank money in particular to remain future-proof. And I think it is very recent developments have sort of affirmed the somewhat new urgency with which these are being pursued. For example, the executive order by US President Biden emphasizing that the US wants to be a leader on CBDC and digital assets, I think it's giving it a whole new sort of dimension, which is CBDC as a strategic instrument to ensure monies remain competitive. And that echoes only what the ECB had announced earlier, namely that a digital euro is to serve to give greater strategic autonomy to the European Union. So I think CBDC is increasingly becoming sort of a key instrument as part of a broader strategy to make sure monies remain competitive. That I think is is what recent developments seem to confirm. Thank you.
Thank you very much for that, Osmin. I think certainly the debate surrounding money, public versus private money, and where that is going is quite an interesting debate. How that's potentially even moving to platforms and might even change the structure of the financial markets to some extent. I'll move back to Lyle. So Lyle, with the report being released today, why should people read the report? What is interesting? What are some of the highlights to you?
Thanks, Gerard. Yeah, I mean, the report is quite a technical report, right? So it's got a lot of technical jargon in there. But I think it also does point to some very useful insights that we've gained as the central bank. DLT potentially can disintermediate a number of the existing market infrastructures, in the sense that those functions that are currently regulated can be performed on a central or a single shared ledger, for instance. And I think that raises interesting questions for us in terms of how do you regulate something like that? Are we looking at potentially new types of market infrastructures that we'll see in the system? I think the point raised by Osmin around a wholesale central bank digital currency is also quite important. So we do have a digital central bank money, but now we're really talking about a programmability or having the ability to program central bank money, which is different as well. I think things like interoperability between DLT networks are also quite important. If in the future we see different kinds of tokenized instruments issued on different DLT networks, it's important then to create an ecosystem that those systems and networks can talk to one another. And how do you achieve that in a way that ensures the safety and efficiency of the overall system? So I think those are key insights that we've gained. I think for me, the other one that's quite important is, how do you as a regulator regulate a decentralized network? So if we move away from this model of placing all the requirements on a centralized entity, how do you then regulate decentralized networks? Where do you impose the requirements? How do you monitor that? How do you supervise that? So I wish I can say that PK2 provided all the answers for us. I think it raised very important questions. And I think that those questions are important because policymaking is an iterative process. And so I think the insights that we've gained set us on the correct course for purposes of answering these questions and providing that clarity to markets. Thanks, Gerard.
Thanks for that, Lyle. So you mentioned that there's these interesting insights. We've raised questions that need to be taken further. So, Janet, I'm going to ask you, again, as chair of the IFWG, how do we take this? And Lyle mentioned an iterative process. I'm sure consultative and a number of other words could also be used. So how do we take the insights that we've gained from this project and feed that into a number of other discussions that is happening surrounding policy and legislation in South Africa?
So from a policy and a regulatory perspective, PK2 provides us with insights into what the future of trading, clearing and settling of securities in a tokenized world could look like on a distributed ledger technology. And it provides us with valuable insights on how DLT can be used in the securities life cycle. So these PK2 insights gives us more on what we can explore further. To repeat what has been said already, it is not all the answers. It is some of the pertinent questions with some of the answers. So if we look at the main hypotheses of the report and also of the project itself, the policymaker and the regulators will be able to use it to gain insights on competition and how to increase competition and reduce barriers to entry or lowering those barriers to entry for new market participants. We will also be able to look at whether interoperability between DLT networks is in fact crucial or not, and whether consolidation of several market infrastructures into a single shared ledger does have benefits or not.
Thanks for that, Janet. So I'm going to switch over to you some of the more technical questions again. I'm going to try and set that up very briefly. So one of the taglines for the project is that the scope is that we issued, cleared and settled a SOB debenture on DLT. If I can break that down in a kind of a 3-2-1 structure. So we asked the technical teams to build 3 prototypes for us. In other words, a SOB debenture on DLT, a wholesale central bank digital currency, and we used a term that came out of a CPMI, so Committee on Payments Market Infrastructure paper that spoke about wholesale digital settlement tokens, and we just abbreviated that as W tokens. So those were the 3 prototypes. Based on that, the teams built 2 DLT-based platforms for us. So the one is the wholesale CBDC zone, and the other is the Khokha hub. So 3 prototypes, two platforms, and then that formed the one debenture token market. So that was the market that we wanted to build, where people were able to trade in the primary and secondary market. So Toby, again, just based on your background, your experience, you referenced, engaging some industry guys also in terms of decentralized and modular design principles. And then we kind of use this term in the report even of a decentralized financial market infrastructure. So a market infrastructure built on DLT that implements some of these decentralized design principles, including potentially ownership by something like a consortium. So Toby, can you maybe just give us some more insights in terms of how you used those design principles and how they were applied to build the structures that I was referring to?
Certainly, Gerard. I think I can give a couple of example overviews. I think we had a lot of fun by stretching the ideas of liquidity. It's actually a concept that I borrowed from Dr. Usman, where we were looking at our debenture asset that's now tokenized, and we realized that with smart contracts, we can programmatically lock that asset in an absolutely guaranteed way. And this allowed us to create immediate liquidity against an asset that may not traditionally have a very liquid secondary market. So what that means is that I have a security asset, and because the blockchain can guarantee that that asset will not be removed until a certain condition has been met, we can actually make certain future promises of value against that. And these future promises of value look and feel very much like the currency that we use. In actual fact, on a blockchain, it's indistinguishable from currency. So we created what we refer to as an FDM token, a fractionalized debenture at maturity. And if you know the SOP debenture, it's a R1 million minimum value instrument, but which doesn't make for good currency if I have to spend in R1 million increments. So the FDM allowed me to spend in 73 cents, 242 rands, or whatever increment that I would want to, because it was fractionalized. So as programmatic instruments, we were able to leverage this value of using the blockchain and smart contracts to, in essence, you can think of it as issuing a very special line of blockchain credit against your securities portfolio. And because there was no real intermediary required, the fees to this was minimal. And in our model, there were no actual lending fees for you. So you had immediate liquidity against your investment. If we look at some of the other interesting things where we tried to push the boundaries was in specifically the wholesale token, the W token stablecoin. And what's challenging about this from a conceptual view is because stablecoins and currency that we understand in the regulated markets today are issued by a single issuer. And yet we look at decentralized currencies that are issued by many different issuers. And it raises lots of regulatory questions for us. So in taking the view on how to design a W token, and the brief to us was create an instrument that could be used by all the participating banks to settle that was not issued by the Reserve Bank. And that was an interesting challenge. So we looked in the decentralized finance markets again at the MakerDAO infrastructure, how the DAI stablecoin instrument was established. And this gave us a hint about potentially other interesting opportunities that we could leverage from decentralized finance and bring into regulated markets, as we believe there's a lot of learnings to be had there. In our W token model in Project Khokha 2, each participating bank could issue as many W tokens as they wanted to, as long as they were able to earmark sufficient funds in their Samos account. And if they had a reserve of funds at Samos, we would literally give them this line of W token credit with which to trade on the blockchain in the PK2 hub, or Khokha hub as we've been referring to it. And again, if they had any surplus of these tokens, what they could do in turn is reduce them and release the earmarking that they had done at Samos to gain access to their liquidity at Samos. And the question that the astute listener would ask is, but what happens if I have more W tokens than I created for myself? Well, those could be redeemed for central bank digital currency, as long as we had all the other participating players form fulfill their responsibility at the end of the day to settle up at the surplus balances that was required. And I really look forward to people studying this model more in the report. It was very exciting to be able to push the boundaries in such a way. Our token trading platform, the Khokha Hub, this was basically there setting a precursor for what we think is the future of the industry network that might one day give all financial market participants access to sophisticated clearing and trading functions, because these regulated service providers currently, there's restrictions in terms of who can settle on the Rtgs. And we believe that a token trading platform, as the one that we've established with the Khokha Hub, where upon all these programmatic instruments actually function, is actually a wonderful example of what it could look like in an imaginary future as we work through the regulatory requirements to get there, where more participants can get access to these functions in a regulated and a compliant way. And I think that it's what the biggest insight for us were in the process was that with the fourth industrial revolution and with all this integrated global financial market that's taking place, and we're seeing that we're all closer than we ever thought we were, it's exciting to see that DLT and blockchain is actually bringing new opportunities for us to meet the challenges of this new ecosystem. And it's very encouraging because I believe that there are great solutions to many of the financial market challenges that we face today to be found in this space.
Thanks, Toby. So I'm going to head over to Osmin quickly. And I'm probably going to pose two questions to him. So Osmin, you heard Toby refer to you. You referred, and you heard his discussion surrounding creating liquidity in the market. So obviously, well, I say obviously, but just by way of explanation, the benches are a policy instrument. They are used to drain liquidity from the market. So as people buy the benches, it takes money out of the market. As Toby now explains, tokenization can be used to introduce liquidity back into the market. So Osmin, the first question is, maybe you have some thoughts on that. And then the second question relates to, with a lot of innovation now happening by fintech firms and potentially big tech firms, exploring things like stable coins in particular, what's the potential role? Is there still a role for a central bank instrument like a wholesale central bank digital currency? Osmin?
Thank you very much, Gerard. On the liquidity question, it is a discussion you remember, of course, we had during the project. To what extent could a tokenized debenture serve the opposite of what the a CBDC would achieve? Namely, the CBDC is to inject liquidity into the market, and a tokenized debenture could be there to absorb liquidity. So we effectively create, two critical instruments, of course, to influence monetary conditions. Now, the important thing is the concern that the introduction of a CBDC and tokenized debenture should not lead to a fragmentation of the money market. I think that is something that we had discussed at the time. Namely, we shouldn't have separate pockets of liquidity somewhere that are trapped because of the nature of the instruments. On the contrary, the back-end architecture of the instrument should not play any role, and resources should be able to flow between whatever systems we are using, also thereby allowing Samos to continue to play its role as the main infrastructure to establish monetary conditions. So I think the idea of CBDC injecting liquidity and tokenized debentures absorbing liquidity just illustrates that tokenized instruments can be very effective as well in changing monetary conditions in the money market. On the idea of will stablecoins crowd out central bank money, and no panic, the SARB still has work to do. Now, I think not at all, actually. Central bank money, I think, has a very special role. In particular, it is the anchor in any currency area, and it is also there to ensure that the national currency preserves its singleness, so to say. That means that there's only a single price for the national currency. So central bank money is the money of the highest quality in any system. It is therefore the preferred instruments for very large value payments transactions. So, for example, clearing in Samos. And I don't think really has a substitute, but we could come very close. And I think Toby referred to the W token. That is a way of ensuring that a stablecoin can be of very high quality, similar to issuing a stablecoin coin under provisions of a money market fund, for example. So I very much see the complementarity between the different monies, and to some extent, maybe a new division of labor. And where central bank money is not available, stablecoins could play a very useful role, where bank money, properly speaking, is maybe too risky. So for me, it's about the development of a continuum of money. And I think central bank money will remain the anchor, but other monies like stable coins could play a truly very useful role. Thank you.
Thank you very much, Osmin. So as I said, we'll probably do 2 rounds of questions and then move to some of the questions in the Q&A section, and then start to take it from there. And we might jump between some of these questions and prepared questions. And as I also mentioned, we'll try to answer most of the questions, but it's very possible that we won't get to everything, particularly if you're from a media house. You also have the opportunity to post questions to us through the SARB's communication division, and we'll take them from there. So the first question, I'll read it out, and I'll maybe give both from a technical perspective as well as from a policy regulatory perspective some of the panel to answer. So if I can almost summarize it, the question is, although we've done this project in a controlled environment, do we think that it's possible to have a stock exchange completely on DLT, basically? And the question also then asks from a policy stance, but I want to highlight, I think there's two elements to that. So DLT is suitable for many instances, but not all. So maybe Janet and Lyle, the first question from a policy perspective. So obviously there's some regulation involved. Do you guys have any thoughts in terms of, would it be possible under current regulation to build an exchange on DLT? And maybe highlight what some of the key pieces of legislation are that might need to be looked at. So I'll open the floor.
Thank you, Gerard. So I'll kick us off from an IFWG perspective. So under the current environment, it is in fact not possible. Some of the key pieces of legislation that we would need to take into consideration would be our current Financial Markets Act, which if you are familiar with the work that National Treasury is doing in that space, you would know that there is a review that has been published on the National Treasury website. And we also need to then look at whether it is in fact money as defined within the South African Reserve Bank and Banks Act to then decide on that. With regard to the policy question, whether it is theoretically possible, the PK2 test has shown that we should be exploring it further because it might be possible, but maybe not appropriate in all circumstances. But I'm sure Lyle will have some additional insights from a more SARB fintech unit perspective.
Thanks, Janet. Yeah, I think the question's interesting, right? Because it sort of goes to the heart of the issue. So if we say that we are technology agnostic, then what does that mean? Does that mean that you, regardless of the kind of technology that you have, that you could still continue to perform those functions? I think that even if you are technology agnostic, the technology does matter. If the technology introduces risks to the business, then I think the regulator does need to take note of that. The other question, of course, is if you're talking about an exchange, which is a platform for trading securities, is a tokenized security a security? I think that that's a question, right? We haven't answered that question. It's something that we do need to consider. And then, of course, how do you settle that tokenized security? What forms of money are then available on some kind of distributed ledger network that allows you to settle that trade? And how do those transactions interface with the existing payment infrastructure in terms of the Rtgs? So those questions are outstanding. I think those are things that the regulators need to explore as well before we can definitively say that, yes, you could have an exchange that operates on DLT. What we've seen in other jurisdictions is that they've enabled DLT environments to allow for trading, clearing, and settlement on blockchain technology, for instance. And so I think that is something that we would need to continue to look at from a South African perspective as well. Thanks, Gerard.
Thank you very much, Lyle. So, Toby, maybe just very briefly, I know you've expressed some thoughts in the past. From a technical perspective, do you think it's possible to translate all elements of trading, the trading life cycle on DLT? Very brief response. Thanks.
Thanks, Gerard. I think anything is technically possible, but I would caution everyone that the amount of business process implementation required with corporate actions and everything else that we see in the actual exchange markets would be a challenge. It is definitely not technically impossible, but I think one of the major things to consider is that customers are used to trade mainly in a post-funded model in current stock exchanges. You can book a trade with your broker. And in terms of our DLT environments, and especially what we looked at the secondary market trade functions in PK2, it was a pre-funded model. You had to pay before you were able to trade. And I think that's a behavior change that customers will have to go through in order to adopt this technology that is even far beyond what the regulatory requirements may be.
Thanks, Thierry. I think there's some views as well in terms of front end versus back end. And so I think it's an interesting discussion. I think a lot of experimentation also on the back end. So what can DLT do specifically surrounding clearing and settlement? There's some questions that I'll try and answer, but just because this project is focused on wholesale, not retail, there's definitely elements that I will not get into. So I think Marius Oosthuizen, so a time frame for going live. There's a different project looking at the retail elements. So I'm not gonna speak to that. I think even from a wholesale perspective, it depends on what you want to do, and there's different. What is useful about the project is that it highlights different views. But as the discussion highlights, there's a number of policy and regulatory things that might have to change, and those things also, as highlighted, often do take time. I'm looking at Rachel Savage's question, whether we are concerned about being left behind. So this, again, elements of this refers to retail CBDC. Again, that's not the purpose of this call. I think it's always, as highlighted by the governor, it's always better to be cautious about these things, to understand them properly, rather to jump ahead and kind of implement something that doesn't make sense. So a lot of work still needs to be done, even in the wholesale space, determining and refining the policy imperatives. Just from a policy perspective, is there any kind of feedback in terms of, if I can, one of the things that the report, and I'm thinking, Janet, particularly for you, so the report speaks about this need to be adaptive, agile, and even anticipatory to some extent. Maybe you can speak to that element. What do we mean by those things?
Thank you, Gerard. And I just cannot resist the temptation to do a little bit of marketing on the IFWG, in the sense that we, as the IFWG, we want to promote financial inclusion while promoting competition, financial innovation, digital skills, and economic growth through these innovations. So the IFWG members include both policymakers and almost all, if not all, of our financial sector regulators. And by working on these various projects and exploring these use cases and following a sandbox approach where we can do testing within a confined space, it allows the policymaker and the regulators to then adjust our policy and regulatory frameworks as appropriate and within a relatively short time frame. Having said that, the old adage is that the regulation always follows innovation. And the challenge remains where current legislation does not cater for the emerging innovations, and then the formulation thereof in the market structure.
Thank you very much, Janet. So I'm just looking at some of the questions. The one that I saw was from Rita. So again, this is for me more a retail CBDC question. I'm not going to go into the detail of that. Again, it's not the focus of this project. I think I just want to highlight, so this idea of privacy, and I'm going to confuse two words now, but it's possible for you to have privacy, but it's also possible for you to be pseudonymous, if I can use those words. I know it's not 100% the correct words. So there's different design options which need to be considered and analyzed. But again, it's a different project that is exploring those. I think just from a general DLT perspective, on the environment on PK2 is a known environment. So more permission networks where the players are known. So I'm going to move on to Kombi Kaponda's question. So he says, thank you for insightful deliberations sorry, the question's jumping around a little bit. So with the progression from PK21 to PK2, looking at tokenization, do you see wholesale CBDC replacing the current Rtgs system for interbank settlements, and how will cross-border CBDC interoperate with other already existing payment systems like the SADC Rtgs, COMESA, REPSS, and other cross-border mobile financial services? So this is something, again, that is very much being explored in different projects. It's something that we can't conclude on at this moment in time. There's also an Rtgs renewal project. The PK2 report does speak to this a little bit in terms of how potentially the wholesale CBDC platform could integrate with, for instance, the domestic Rtgs system. The governor also referred to the Dunbar project for cross-border exploration. Lyle, I'm going to pose the next question to you. So from a well, it's not a SARB sandbox. I just need to highlight that. So the question asks about the SARB sandbox for crypto asset-based testing. So both of you can actually jump in on this, Lyle and Janet, but it's an IFWG sandbox. When are we going to open that up again for testing? I know that it's currently closed, and then particularly would there be a focus on maybe crypto asset service providers?
Yeah, I'll start, and Janet can absolutely jump in. So I think currently in the sandboxes, we do have crypto use cases that are being tested. And I think they are providing valuable insights for the regulators in terms of how the regulatory frameworks potentially need to be adapted to address crypto assets. We are also looking to open up the sandbox process again towards the middle of this year. We've done an assessment to see what worked, what hasn't worked. We're trying to improve the process to make it better, but we absolutely do anticipate that we'll open up the applications again and then receive applications. I think for purposes of the next session or the next round of applications on the sandbox, one of the things that we are looking to do is to say, what are the regulatory priorities for the regulators, and how do we then get value-adding use cases into the sandbox in a way that actually does inform the regulatory framework? So absolutely, to the question that's been asked, we will be opening up the process again. I'll hand over to Janet if you have anything to add, Janet.
Yeah, maybe just a small technicality to add. As Lyle said, we are looking at improving the processes. So at the moment we had a cohort-based approach, which we have now amended to be an adjusted rolling-based intake for the sandbox. So just that one technical addition. And we're hoping to open the sandbox within the very near future again. But other than that, we will not have a specific focus on specific topics, but it will be evaluated in the normal sandbox processes through the Innovation Hub. Thanks.
Thanks, guys. So we have about 10 minutes left. So we definitely won't be able to address all the questions. The next one again is addressed to the SARB in terms of whether we foresee a national ecosystem that is network across border, cross currency. Again, some of this exploration is underway. One of the reasons why we wanted to test interoperability on the project is to see how this might work. But I'll maybe pose this question to either Twibi or Osmin as well. So kind of your views on interoperability between different systems and across countries for different DLT-based networks.
Shall I start for that, or Toby?
Yes, Osmin, please.
All right. No, interoperability is, of course, absolutely essential. And I think to some extent, or to a large extent, it actually has been solved. The idea that we need to have a fluid interaction between different blockchains. That's the idea, of course, of interoperability. And we have had a number of projects where we have explored it. It was explored in Jasper Ubin, between the Bank of Canada and Monetary Authority of Singapore. We had it as well as a central element in Project Jura. To a large extent, technologically, I think the problem has been solved. It is critical, of course, to ensure that we do not depend on a single standard, but rather think about blockchain having to have the ability to communicate with other blockchains without necessarily, having to operate the same system. That is quite key also for financial innovation, because we don't want to be logged into a standard that may, in fact, discourage further innovation too soon. So this is why interoperability is key. And for international payments, but also for domestic payments, the idea to basically work across different chains, irrespective of geography, has to be the objective. Again, it's just to say, I think we've solved it to a large extent already.
Thank you very much, Osmin. Just checking the feedback there. So maybe two more questions. One of the questions that I'm going to pose to Janet is from a Mr. Enrich Duisman. He asks, in terms of the principles for financial market infrastructures, what insights were gained from the project in terms of compliance with those principles for financial market infrastructures? So maybe just a little bit of background on these principles. They apply to, I think for us sometimes it makes sense because, by definition, but the national payment system as an example is a financial market infrastructure. Something like a stock exchange is a financial market infrastructure. And then other payment systems, which stable coins could be classified as, could also be seen as financial market infrastructures. But Janet, any thoughts in terms of what we learned on the project in terms of compliance with these principles?
Thank you, Gerard, and Andrew, thank you very much for the question. So if you look at the principles for financial market infrastructures, it goes to, for example, the resilience of our financial market infrastructures. And we don't necessarily have all types of financial market infrastructures in South Africa, such as trade repositories, but it also goes to our exchanges or trading venues, central clearing counterparties. There are various types of financial market infrastructures. So we did have some insights into how we can possibly comply with the principles for financial market infrastructures as set by the colleagues in Basel in Switzerland. And it also, you need to think about how this also then links to, for example, cyber resilience for financial market infrastructures. So it would not only be the pure compliance with the PFMIs, but also looking at those underlying risks from an operational perspective. But a lot of detail is available in the report itself, which is published today.
Thank you very much, Janet, for that. So the last question is a question I'm not going to take from the Q&A, but it's a question that I'm sure people want to know. And I think Lyle might know that it's coming her way. So Lyle, now that we've completed the project, I think the question on everybody's lips always at the end of these things are, so what's next?
Yeah, that's a good one. What's next? Where to from here? So there's work that we are currently doing as part of a project called Project Khokha 2X, and that looks at building on top of the prototypes that we developed in PK2. And that already, I think, is giving us, again, the opportunity to explore different use cases. So different kinds of securities, not debentures, exploring things like stable coins as we grapple with how do we respond to something like a stable coin? What people often want to know is when do things go live? When do we enter the live environment? I think for you to be in a live environment, you need to know what the regulatory framework is, right? So one part of it is what technology enables, but I think the technology needs to be grounded within a regulatory framework that supports it, that provides clarity around things like, who has rights in this scenario, that provides that legal certainty. So for us to get to a live environment, whether it's in a sandbox environment or whether it's in some kind of different use case, I think we would need to be clear on what the regulatory interventions are, put those regulatory interventions in place so that the live environment can be appropriately supported. I think that is ultimately where we want to get to. For now, I think we are still building on the work in PK2 through this technical sprint that we are undertaking. But we absolutely, I do foresee that we could get to something like a live environment in something like a sandbox. Thanks, Gerard.
Thank you very much, Lyle. So thanks to all the panelists. So going from kind of the back to front this time around, so it was me, Toby, Janet, and Lyle. I think I can't wrap it up any better, Lyle, than what you've done. So there's a lot of questions about production, but very much exploration at this stage, the analysis of the implications, considerations surrounding policy and regulations which need to be updated in many instances. But with that, it's not quite the end. I'm going to hand over to our executive sponsor, Deputy Governor Rashad Kasim, who's led us very ably. And we are very excited to serve him through this project, and he will wrap up proceedings for us. Over to you, DG Kasim.
Harold, thank you very much. This was a really interesting panel, and thanks a lot to the panel. I was quite struck when Project Dunbar, which the governor referred to, was launched. I was following a tweet on Project Dunbar, and I think that it was maybe the project that described it this way, or the tweet said, Project Dunbar ended with more questions than answers, and more questions than before it started. And I think this is how it goes with these kind of projects, that the more questions you have than before you started is really a sign of progress. We're dealing with very complex technology. We're dealing with a leap in change in mindset, and these are not straightforward. I think that the other important issue that excuse me, that came out from this process was that one thing is very clear, that there is a complex of activity in this space that you have to navigate your way around. The whole CBDC in the retail space is, in some respects, fundamentally different from CBDC or more generally DLT in the structure of finance, in financial market infrastructure. As the governor said, the SARB is trying to work in both sides of these two critical areas. Sometimes you can work independently of it. Many central banks are now using CBDC without, on the retail side, like Barbados, not quite working on the wholesale side. And there are, different elements to this. I think that, as the governor emphasized and as the panelists emphasized, why do we want to do all this? And I think that it's like going back to asking the question, do you as a central bank want to embrace the internet, the intranet, and so on? And I think that, it has the potential to provide efficiency gains in processes that require lots of intermediaries. And I think that's one of the main benefits of these, of our experimenting with this, is really the attempt to capture on efficiency gains with all the caveats that the governor spoke about in his speech. Another thing that's also very, very clear to me is this thing cannot be done by government or central banks alone, and that every sector of society, the private sector, has its own comparative advantage. It has a deep understanding of the complexities of technology in a way that central bankers do not. Central bankers have a different comparative advantage. Central bankers have a regulatory function. They have a function to keep financial markets stable. And this leap into some of these kind technologies require really collaborative effort. No one can do it on their own. The private sector needs clear regulation. The central bank needs to understand the actual technology that the private sector has a comparative advantage. One of the questions that came up in the chat was, are we concerned, and Gerard talked about the question, are we concerned that we're missing out, that we're too slow, we're too fast, and so on? This is an issue that really in the central bank community, we've been grappling with in one particular area, and that is, the question we've been asking is, if you look at, for example, the area of retail CBDC, do you want to kind of leapfrog into using CBDC, or do you want an incremental improvement in your payments system infrastructure? That question of leapfrogging or using existing technology is something that runs through many of the projects in the SARB, and as a result, I think that these are issues that we are worth going to explore in the detail that it deserves. I mean, Lyle was faced with the question, why where to from here? I think that's the real challenge. The real challenge is that we have been doing Project Khokha 1. We've now completed Project Khokha 2. We have two very important, one important project on CBDC. I think that moving from proof of concept to kind of real-time engagement with this technology is going to be the big challenge. I think there are too many questions, as the panelists have pointed out, that many things to resolve. We're talking of daily liquidity. These are issues you can't mess up. We have a mandate of financial stability, and this has to be properly taken care of. So I think it's this kind of balance between making good use of the technology, not lagging too much, but ensuring that as a central bank, we have mandates that provide stability to the financial sector. And that mandate of stability to the financial sector will in some ways overshadow the pace with which we move on some of these issues. So once again, I think that this has been a fantastic launch, thanks to the panelists. But let me also take this opportunity to thank Lyle, who's the head of the FinTech unit, Gerard, who has been most central to this project, and the entire FinTech team, the bank, the communications team. And I hope that this project and the report, which I presume will be put on the website now, provides an opportunity for us to take this forward, to release the results, talk about it, look at the questions we didn't think about before the project, and progress. So thank you, everyone, for a fabulous session. Cheers.